What if financial freedom isn't about how much money you make, but about how much your money makes without you? Because that's the idea most people never get. Some focus on income, value investors focus on assets, and the difference between those two is time. Today, I want to walk you through how to build a portfolio that isn't just growing, but working toward financial freedom. First, let's get something straight. Financial freedom doesn't mean being rich. It means your investments generate enough income to cover your living expenses. That's it. If your life costs $60,000 a year to run, and your portfolio produces $60,000 a year without you working, you're free. So the question becomes, how do you build that machine? The first mistake people make is building a portfolio around excitement. Things like hot stocks, trending sectors, or high-growth stories. But a portfolio for financial freedom isn't built on excitement. It's built on reliability. To create a solid foundation, you need assets that do three things: grow, produce income, and survive downturns. Let's break this down. First, growth assets. These are the engines. Think broad market index funds, high-quality companies, and businesses with durable earnings. These assets don't just move in price, they grow because the underlying businesses grow. This is how your portfolio expands over time. Without growth, inflation quietly eats away at your gains. Growth is essential because it protects your purchasing power. Next, we have our income-producing assets. At some point, growth has to convert into cash flow. That might look like dividend-paying stocks, REITs, bonds, covered call strategies, or simply selling appreciated assets strategically. The key is this: financial freedom requires income, not just appreciation. A portfolio that's worth $1 million on paper means nothing if it doesn't produce usable cash. Income is what pays your bills. Last but not least, we have stability and durability. This is where most people underestimate risk. Your portfolio must survive recessions. That means avoiding excessive leverage, diversifying across sectors, holding some defensive positions, and keeping liquidity. You don't need perfection, you need protection. Because the fastest way to delay financial freedom is to blow up your portfolio in a downturn. With the foundation set, let's talk structure. Instead of asking, "What's the best portfolio?" ask, "What does my life cost?" Start at the end. If your annual expenses are $50,000 and you believe your portfolio can safely generate 4% per year, you need roughly $1.25 million invested. That's the math. $50,000 divided by 4% equals $1,250,000. This is called a withdrawal rate, and it forces clarity. Now your goal isn't vague, it's measurable. But here's the part people tend to resent. Time matters more than return. If you invest consistently, reinvest dividends, and allow compounding to work, the machine builds itself. If you interrupt compounding with emotional decisions, you reset the clock. So how do you actually start building this? By keeping things simple. Your core allocations should look something like broad index funds for growth, income layer for cash flow, and a defensive buffer for stability. Try to avoid concentrated risk, emotional overtrading, excessive fees, and high leverage. Financial freedom is not built by complexity, it's built by consistency. Here's the takeaway. A portfolio for financial freedom is not about maximizing gains. It's about building something that grows, pays, and survives. If your portfolio does those three things, you're not chasing freedom, you're engineering it. Financial freedom isn't about luck, it's about structure. If you want to build it the right way, subscribe. We're just getting started.